Hello, welcome back. So Warren Buffett disclosed the large stake that he took in HP, Hewlett Packard. And for this reason, we're going to be making a video and examine the company. See whether it's actually worthwhile for us to invest in the company as well, because whenever Warren Buffett is involved in something, then we definitely want to be taking a look, because he really knows his stuff, of course. So, this stock news module here kind of tells us what has been going on with Hewlett Packard right now and Warren Buffett. And you have seen that the stock has been soaring a little bit, although today is actually down. But let's take a look at the stock analysis chart and figure out what we can do with this company, whether it's actually worthwhile to buy or not. And as you'll see here, it's down 3.7 today, but look at yesterday, April 6, 2 days ago pretty much. It used to be 34 and closed, pretty much closed at about 35. And actually went up to 40 in April 7, and today is down a little bit at 38.59. Now, if we go back at the max chart and see what was happening with the company, we will see that it has had its highs, and then it has gone down a bit, corrected, and then hit an upwards momentum again. And so it is a company that is going up and down quite a lot, and right now it's sitting at its all-time highs, it looks like. So we have to be super careful about it. Now let's take a look, because the price of the stock doesn't really tell us whether it's a good purchase or not. We need to examine the financials. And so the P ratio of the company is actually fairly low here, is actually almost 7, actually less than 7, which is amazing. Looks like the company is making a lot of net income when you compare it to its stock price. The same thing with the price to free cash flow ratio. I would expect nothing less of Warren Buffett. Companies of this sort with these very, very low ratios here are very, very interesting. Outstanding shares are massively going down as well. The company is buying back shares like crazy in the last 5 years. Another awesome thing to see. Free cash flow to total liabilities is about 7 years of the free cash flow that the company made last year to pay all the total liabilities. That's a little bit more than I would want, but it's still fine. The 5-year revenue growth, this is a company that you wouldn't expect to grow insanely because it's already a very, very big company. Yet it's still growing rather nicely here. Like in the last 5 years, it has been growing pretty much all its figures here. Even its equity growth, although it's negative here, it has been growing. Okay, now a negative equity growth and a negative equity pretty much can be a bad thing. It kind of depends on the debt, but it really, really matters how much free cash flow the company is making, because they could be deciding to take quite some debt. It kind of has to do with management in some situations. Now, the debt to equity ratio is actually very high here, minus 17.7. Which means that we have negative equity and quite some debt. It's what you can deduce here, and this is why the return on equity is negative as well. So this is a thing that I don't really like. But what I do like is the dividend payout ratio on 2.3% dividend yield. This is very low, 14%, 14.7%. They can actually pay it all for the next century or so. So that's amazing that they are paying 2.3% with a dividend payout ratio of 14.7. We typically want to see less than 50. So anything less than that is great, and 14.7 is awesome. So let's take a little bit of a closer look now, and I'm going to examine the company's financial statements here just to see what they're doing in terms of the free cash flow and net income here. Because you will see that, the net income of the company has been decreasing a little bit, although in the last year, the fiscal year 2021 pretty much, has grown quite substantially. It has surpassed all the previous years, so that's nice to see. So it is growing its net income, which is cool. What about the balance sheet? Why do they have they have negative total equity here? So it looks like they have many liabilities. They do have assets, but they have many liabilities. Quite some debt here, I'm seeing. And what else we can deduce from here? Some non-current liabilities, but for the most part is the current liabilities. As you can see, they have liabilities that need to be fulfilled in the next 12 months. Same thing with account payables. So it's for the most part operational debt. I should say liabilities, as they are called, not really debt. So they have account payables here. Okay, that's fair. It would be nice to see them, increase their assets a little bit, their equity here. But, as long as they know what they are doing with the debt, that could be okay. And as long as they are making enough free cash flow to support that. I still like companies that create some positive equity. It looks like it's getting better though. So they're actually amassing a little bit of equity here. slowly year over year, so that's at least good. But let's take a look at the cash flow statement. So they had about what total liabilities were at 40 billion, I believe, 40.26. And if we go to the cash flow statement, remember we noticed that it was about 8 years or so, if I remember correctly. So yeah, about 8 years of free cash flow, 7 point something. That we need to amass in order to pay all the total liabilities. So they are increasing their free cash flow here. That's a good thing. And yeah, as you'll see here, it's mostly about the net income for the most part. A little bit of stock-based compensation and depreciation and amortization added back, but that wouldn't worry me too much. And the capital expenditures here, very normal, pretty much the same every year, another good thing. And investing activities, a little bit of investing here, acquisitions and the likes. And what about the financing activities? So over here, the company is spending a lot. It looks like they're repurchasing shares, which is of course amazing. I love to see that. So that's a fantastic thing for the company. And the free cash flow is also increasing. So yeah, apart from the fact that they have a lot of debt that I'm pretty sure it looks like they're managing, because they are making a lot of free cash flow. So it's probably not their priority right now to pay all the liabilities that they have and the debt. And yeah, I wouldn't be that concerned about this would be much more concerning to me if the company wasn't making good net income and good free cash flow. When they do make that, I'm okay with the company actually spending money and actually getting debt, because debt can actually leverage the company, can actually help with leveraging operations, so it can be a good thing. So next up, we're going to examine how much we should be willing to pay, though, because we're looking at a company that it is at its pretty much all-time highs. It looks like it has great financials, but is it a good purchase today for us? Let's see. So they're doing pretty well in terms of revenue growth for a big company. I mean, they're still kind of increasing here their revenues, not by much, of course, so we need to be conservative. So like 2, 3, and 4 is going to be our conservative estimates here. The net income margin is relatively low. We're going to go 5, 4, 5, and 6. And the free cash flow margin is fair. We're going to go 80, 90, and 100 here. And so the annual return that we're going to be using is going to be 13%, which is what we want to be making, because a fairly standard ETF makes us about 10%, like an S&P 500 makes 10% a year. So we need to be making more from a single stock because we're taking up more risk. So let's hit calculate and check. Yeah, this is what I would expect, actually. And for the low estimates, we are sitting at a little bit more than we would like to sit. The medium ones, we are close to the current price and a little bit elevated, actually. So that's good. So this is green for our medium estimates and green for our high estimates. And our medium estimates are very fair here. Their medium projections are like the 3-year average revenue growth, as you can see, with less net income margin and less free cash flow margin. So that's very fair here. We can definitely see the company achieve that for sure. So yeah, I kind of like HPI. I totally understand why Warren Buffett would get into this one, for sure. It looks like a company that has its merits. And the fact that they are paying dividends also that are actually look at least so safe based on their payout ratio, it's great. And as long as they kind of like handle the debt a little bit better, I feel, which they may already be actually. It's just a matter of what they saw on paper, but the way they're handling it could be just fine. It's just what we're seeing here with the numbers. But as long as the debt is fine, which I think they will handle, they're making quite some good cash here, so they should be fine, more than fine. I see this company as a total buy right now. It looks great, and I really understand why Warren Buffett would want to get into this one. Makes a lot of sense. So I hope you enjoyed this one, and if you did like the video, please leave a like and subscribe. Remember to subscribe, because I'm currently working on setting this whole tool up online so that I can actually give access to you guys. And so be around when that happens. I will let you know how to get access. And this is going to be in about a month or so you may want to subscribe and get the information, get the news first. And in the meantime, if you're interested in more of these similar type videos, take a look at this company that I made a video for. It's called System 1, a trendy company, and which is also trending right now. So take a look at what it's doing financially and whether it's worth purchasing that one. Thank you for watching this one, and I'll see you in the next one. Bye bye.